Where does money come from? If you think the answer is the government prints it, you're not alone, but you're wrong. And once you understand how money is actually created, you'll see the entire financial system differently. This might be the most important economics lesson you were never taught. Let's get into it. Let's start with a question. Where does money come from? Most people say the government prints it, or the Federal Reserve creates it. And technically, a tiny fraction does come from those sources. But the vast majority, it comes from somewhere most people never suspect. And when researchers surveyed the public, they found that even highly educated people overwhelmingly get this wrong. Here's the truth that blew my mind when I first learned it. About 90% of all the money in the US economy, and up to 97% in the UK, is created not by the government, not by the Federal Reserve, but by ordinary commercial banks. Your bank, Chase, Bank of America, Wells Fargo. Every time they make a loan, they create brand new money out of thin air. And this isn't some fringe theory. The Bank of England published a paper in 2014 explicitly confirming this is how the system works. Let me show you exactly how. Here's how it works, step by step. You go to a bank and ask for a $200,000 mortgage. The bank checks your credit and approves the loan. Now here's the part that shocks people. The bank does not go into a vault and take out $200,000. It does not take that money from another customer savings account. It simply types $200,000 into your account. That money is brand new. It did not exist 1 second earlier. The bank created it through a keystroke. You then spend it on a house, and that money flows into the economy. And here's the flip side. When you make your monthly payments, the principal portion of each payment destroys money. It's created through lending and destroyed through repayment. Money is constantly being created and destroyed. Let's look at the accounting. When the bank makes a $200,000 loan, two things happen simultaneously. On the asset side, the bank gains a loan receivable. That's the money you owe them. On the liability side, your account gains a $200,000 deposit. That's the money you can spend. Both entries were created at the same moment from nothing. The loan is the deposit. They're two sides of the same coin. This is the exact opposite of what textbooks teach. Textbooks say deposits come first, then banks lend them out. The Bank of England says no, loans come first and they create the deposits. The causation is completely reversed. Now let me address the money multiplier, probably the most widely taught and most wrong concept in economics. Your textbook says, a customer deposits $1,000, the bank keeps 10% as reserves, lends out the rest, and through a chain of redeposits, that $1,000 becomes $10,000. Sounds logical, right? But it's backwards. Banks don't wait for deposits to lend. They lend first, and the deposits are created automatically. They find reserves after the fact if they need them. And here's the proof. Several countries, including Canada, the UK, and Australia, have operated with zero reserve requirements for years. If the money multiplier were real, those banking systems would create infinite money. They don't. And here's the kicker. On March 26, 2020, in response to COVID, the Federal Reserve set the reserve requirement to 0%. Banks are no longer required to hold any fraction of deposits as reserves. And the Fed has said they have no plans to bring it back. Now think about this. If the money multiplier story were true, that reserve requirements are what stop banks from creating infinite money, then we should have hyperinflation right now. But we don't, because reserve requirements were never the real constraint. The real constraints are different. So if reserves don't limit money creation, what does? 4 things. First, capital requirements. Under Basel III rules, banks must maintain real shareholder equity. If a loan goes bad, the bank loses actual money. Second, risk management. Banks don't want to make loans that won't be repaid. Third, demand. Banks can't force people to borrow. In a recession, even if banks want to lend, nobody wants to take on debt. And fourth, regulation. Stress tests, liquidity rules, and oversight. Now you might ask, what happens when all 4 of these constraints fail at once? That's exactly what happened in 2008. Banks made millions of reckless mortgage loans, creating enormous amounts of money. When those borrowers defaulted, the money was destroyed, but the debt remained. That's a financial crisis. So what does the Federal Reserve actually do? It does not print money and hand it out. The Fed controls the price of money, the interest rate. When the Fed raises rates, borrowing becomes more expensive, fewer loans get made, and less money is created. When it lowers rates, borrowing is cheap, more loans get made, and more money flows into the economy. Think of it like a thermostat. The Fed doesn't create heat directly. It sets the temperature and the system adjusts. The actual money creation still happens at commercial banks. The Fed just makes it easier or harder for that to happen. Now let's talk about quantitative easing, or QE, probably the most misunderstood policy in all of finance. When people say the Fed is printing money, they're usually talking about QE. But QE is not printing money and handing it out. Here's what actually happens. The Fed electronically creates bank reserves, a special type of money that only exists within the banking system. Then it uses those reserves to buy government bonds from banks. The banks now have reserves instead of bonds. Their total wealth didn't change. They just swapped one asset for another. It's like exchanging a savings bond for cash. You're not richer. Your money just changed form. And here's the key. Bank reserves cannot be spent at stores. They exist only between banks and the Fed. Let's look at the actual numbers because they're staggering. The U.S. money supply, measured by M2, was $4.9 trillion in 2000. By 2008, it had grown to $8.2 trillion. By January 2020, right before COVID, it was $15.5 trillion. And then in just 2 years, it exploded to $21.7 trillion. That's a $6.2 trillion increase, a 40% jump in roughly 24 months. Meanwhile, the Fed's own balance sheet went from $882 billion before the 2008 crisis to $8.9 trillion at its peak in 2022. That's a tenfold increase. These are numbers that would have seemed unthinkable just 20 years ago. Here's a fascinating comparison. After 2008, the Fed did massive QE, creating $3.6 trillion in bank reserves, but consumer inflation stayed below 2%. Why? Because the money never left the banking system. Banks sat on those reserves and didn't lend aggressively. Asset prices went up, stocks and housing soared, but grocery prices stayed stable. COVID was completely different. The Fed did even more QE, but Congress also sent $5.8 trillion in fiscal stimulus. Stimulus checks, PPP loans, enhanced unemployment, directly into people's bank accounts. M2 money supply growth hit 26.9%, the highest ever recorded. And about 18 months later, inflation peaked at 7%. The lesson? QE alone doesn't cause consumer inflation. But QE plus direct fiscal stimulus? That's what lights the fire. This brings us to one of the most important and least talked about concepts in economics, the Cantillon effect, named after an 18th century economist. When new money is created, it doesn't reach everyone at the same time. Banks and financial institutions get it first, then asset owners benefit as stock and real estate prices rise, then large corporations access cheap credit, and way at the end of the chain, ordinary wage earners and savers. By the time new money trickles down to them, prices have already risen. This is why during 2020 and 2021, the stock market doubled and housing prices jumped 40%, while real wages adjusted for inflation, were flat or negative for most workers. The system isn't broken. It's working exactly as designed. It just doesn't work equally for everyone. So what does all of this mean for you personally? 3 things. First, your cash is constantly losing value. $1 in 2000 only buys 53 cents worth of goods today. Since the U.S. left the gold standard in 1971, the dollar has lost 87% of its purchasing power. Second, asset prices get inflated. When trillions of new dollars are created, a lot of that money flows into stocks and real estate. Prices rise not just because the assets are more valuable, but because there's more money chasing them. Third, savers get punished. When the Fed keeps interest rates below inflation, your savings account is guaranteed to lose purchasing power every year. This isn't a bug, it's a feature. The system is designed to incentivize spending and investing, not saving. It rewards borrowers and punishes savers. So what should you do with this knowledge? 5 things. 1. Don't hold more cash than you need. Cash is a melting ice cube. It loses value every single day. Keep 3 to 6 months of expenses as an emergency fund and invest the rest. 2. Own assets, stocks, real estate, even a small business. These are the things that rise in value when more money is created. 3. Use debt strategically. A mortgage at 6% might sound expensive, but if inflation is running at 3%, you're effectively repaying that loan with cheaper dollars over time. 4. Think in real terms. A 5% raise sounds great until you realize inflation was 4%. That's really only a 1% raise. And 5. Understand the game. You can't opt out of this system, but once you understand how it works, you can stop playing defense and start positioning yourself on the right side of it. Let's recap. Banks create about 90% of all money through lending. Loans create deposits, not the other way around. The money multiplier you learned in school is a myth. U.S. reserve requirements are literally 0% right now. The Fed controls the price of money through interest rates, not the quantity. QE is an asset swap, not printing money for the public. New money benefits those closest to the source first. That's the Cantillon effect. Cash is always losing value because the system is designed that way, and the game rewards asset owners. So become one. Invest in stocks, real estate, businesses. Don't just work for money. Make your money work for you. And that's how money is actually created. Most people will go their entire lives without understanding this. They'll keep their savings in cash, wonder why things keep getting more expensive, and never realize the system is designed to transfer wealth from savers to asset owners. But now you know. So stop playing the game blindly. Understand the rules. Own assets, invest, and make the system work for you instead of against you. If this video opened your eyes, hit like and subscribe, and share it with someone who needs to hear it. Thanks for watching.